Welcome to Sydney, Monem.
Thank you very much.
And firstly, for our viewers, do you mind giving them a bit of background on yourself and of course, Saturna?
Sure. So the Saturna capital actually dates back to 1989 when the founder and chairman started it to be able to manage the first Islamic fund that was launched in the US, the Amana Income Fund. Subsequently thereafter, through different acquisitions, we took on a brokerage company, we started a trust company, and then also grew the Amana brand in the US from Amana Income Fund to the Amana Growth Fund, and then eventually into the Amana Developing World Fund. And right now, currently, the assets stand close to about $4 billion US dollars. From my background, I graduated in 1993 with an undergraduate degree in both in economics and political science. Subsequently got my MBA as well. I've been in Islamic investing since 1995, when it was very, very small. So I've kind of seen the evolution of the entire industry. Joined Saturna Capital in 2003 and kind of went along for the ride as far as the assets were concerned. Currently, I'm working for a wholly owned subsidiary out of Kuala Lumpur, Malaysia. It's called Saturna Sdn Bhd. I'm the president and a portfolio manager as well.
Okay, thank you. Can you please explain the broad and general investment philosophy at Saturna?
The general investment philosophy boils down to two different areas. One is that we are what are called GARP managers, so growth at a reasonable price. So a lot of times we are looking for value companies that are beaten down, that are cheap. However, if there are in industries that we feel in the long run are going to do well, then we will sometimes pay up and go a little bit more on the aggressive side to be able to buy these companies and hold them for the long term, which gets into the second part of our strategy, and that is buy and hold. All of the companies that we buy, our investment horizon is anywhere between 5 and 10 years. So when we buy them, we really want to know what's happening globally, really want to know what's happening in the industry and specifically in these particular companies and how they will benefit in the next 5 to 10 years. So short term, really not that much of a concern, although we do watch them very carefully. We really want to see over the next 5 to 10 years, will they be industry leaders in an industry that is growing and not contracting?
And within, I guess, the global market, how global is the fund, especially in relation to the Crescent International Equity Fund? Is it every country, or do you have a mix of Europe, US, Asia? How does that come together?
I think a good definition of a global is every country that has a liquid public market to trade in. Now, a lot of these countries that we invest in, we might not necessarily go into these particular countries. However, there are companies that are already there. So a great example would be something like a Pepsi. Pepsi is based in the United States, has a global empire of Pepsi-Cola products and Gatorade and other things. So they have a growth company, for example, in Philippines. So if the country of the Philippines is doing well, Pepsi is already established there, their revenues are going to grow. And so what we're really looking for when we talk about global are specific countries, but even more important than that would be multinational corporations that are able to access any and all markets that we want to be in.
What screening processes do you use to ensure compliance with the Islamic investment principles? And importantly, how does that impact your overall investment strategy?
So we actually, in the Crescent International Equity Fund, we use the guidelines that have been set up by AOFI, which is the Audit and Accounting Organization for Islamic Financial Institutions. So they have a set of standardized guidelines, and we're using them to be able to come up with our universe of stocks that we can invest in. Generally speaking, when you talk about Islamic guidelines, what we've found in our 25 years of making Islamic investments is that generally Islamic guidelines help. What I mean by that is that for example, if you look at the debt criteria, any prudent investor will tell you, you want to buy companies with low debt. And the lower the debt, the stronger the balance sheet. So not only are they going to do well in bad times because they'll be able to weather any economic storm, but also in good times they have healthy balance sheets that they can be acquisitive and buy up and coming companies as well. So that's one factor. The second factor is when you're looking at it from a low cash holding of the company itself. that has two benefits also. The first one is that in order to maintain low cash balance, they have to give back the cash to the shareholder. That means more money in your pocket. And the second one is that we want them to be able to use that cash for investment purposes. They know what they do best, which is invest in their industry. We don't want them to become a bank. We want them to make those investments. And so either give it back to us or invest it. Either way, as shareholders, we're looking good.
And my next question is more about how you build portfolios or your initial investable universe. So what quantitative and qualitative analysis do you and your analyst teams undertake before stocks get admitted to your investable universe?
So one thing to understand is that we normally in these companies have a 5 to 10 year outlook. When you're going that far out into the future, quantitative becomes a lot less important. It's more about qualitative. What are the brands? What are the building brands that are going to be truly global? And how are we as investors going to be able to profit from these brands that are out there? Now, we're always watching for and mindful of the quantitative side of a balance sheet, of an income statement, of a company going quarters, 1 year, 2 years out. But when you go out to 5 years, 6 years and onwards, very difficult to do that. So what we like to do is be able to say, look at the demographic trends on a macro level, say where are the trends. From there, look at where are the industries that are going to profit. And then from there, look at what are the companies that are going to be benefiting the most.
Okay, so with respect to your global portfolio, do you have any particular industry biases, or do you focus or like any particular industries?
No, the biases are pretty much, we don't have any biases. We're really just looking for good companies that are going to do well. Now, obviously, because we have a diversified portfolio, we do have to be in multiple industries. And so there might be some industries we don't like, but we still want to have a presence in. So we might underweight one industry versus another. But really, we try to do the bottoms-up research on good companies, good management, whether or not they've been trading. They have been public companies for a reasonable amount of time, so that they know exactly what they're doing when it comes to making public disclosures.
So you've got a pretty large universe of stocks that you cover, and a number of countries that you cover. So how do your analyst teams and research actually undertake the research required to invest in global equities?
So the ones that are inside of our portfolio already, our analysts are constantly looking at the companies and also sitting on the earnings calls, making sure that we analyze the companies on a quarterly basis to make sure they're doing fine. When there's a new idea generation, then there is a set of questions that are asked about the specific company, the industry, all the different environments. That set of questions is basically peer reviewed by another analyst and the director of our research. From there, if it passes those, there's a financial model that's built. That's on the quantitative side. Again, the financial model is more short-term than long-term, although we do have long-term forecasts. And then from there, if that becomes recognized as a good company, we'll bring it up to the investment committee. If it passes the investment committee and gets put into our recommended list, we have a very short universe of investment of basically recommended stocks. If one company gets added, another company has to be dropped off. And so a lot of times there's a very good debate about what companies come off, what companies go on, because I might be a portfolio manager that owns a company that an analyst is recommending to drop. And for more times than not, that's I'm going to have to defend why I'm holding on to the company.
Right. So how does your investment committee process work? How much independence do portfolio managers have? Can the investment committee veto the decisions?
So the investment committee is made up of both analysts and portfolio managers. On a global level, we actually meet on a weekly basis, depending on holidays and those things. And we really discuss macro events, and also during earnings seasons, we discuss different company events that are going on, look at each of the portfolios, how they're doing versus benchmarks, those type of things. However, the actual individual portfolios are left to the discretion of the portfolio manager. He knows their clients the best, so he knows or she knows what companies to include and not to include. So although there might be an investment committee meeting where we decide we want to buy or recommend a certain stock, it might not go in all of the portfolios. That's left up to the portfolio manager to decide.
So with respect to the Crescent International Equity Fund versus other global equity funds and other funds managed by you. Is there anything unique or different about this fund that you think is interesting?
I think in terms of the Crescent International Equity Fund, one thing I think that stands out that we're doing different is that compared to other global funds that we have, or even the benchmark, we are going to be weighting a little bit more in the emerging markets sector. Only because I think that's where the growth is in the future. There's a lot of different factors that go into why the growth will be there, but we are very bullish on that area. And also at the same time, because we are talking about an Australian market and Asia is very comfortable for Australians, there will be a little more weighting in Asia versus other emerging markets as well.
And over time, what differences have you observed or in your experience seen in terms of between conventional international or global equity funds versus Islamic international or global equity funds in terms of returns?
So I think over time, if you look at statistically, there will be periods, small periods of outperformance of a conventional index and small periods of outperformance of an Islamic index. Over time, however, there's statistically no difference. So really what it comes down to is picking a really, really great fund manager who can really outperform. And I think that's really what it comes down to. In the long run, is to be able to outperform, you have to really understand industry trends, global macroeconomic factors, and balance sheets of companies.
And how do you, I guess, perfect follow-on question, how do you see the current global economic climate, especially in relation to global equities?
So, I mean, I think generally, long-term, as we look at a long-term outlook, we're very positive on what's happening in the globe. Usually there's multiple factors that are looked into it, but overall, I think that the growth will be there in the world. And we're looking out 10, 15 years down the road. There are pockets of instability here and there. We do feel in the next 5 years, both Europe and the US, the United States, are going to be underperformance, meaning that their GDP will grow slowly. They'll be coming in and out of recession. So really, over the long run, as a country, that's really not the place to be. However, I think that other countries, the developing world, including China, India, and other countries like that, which have a significant population, there is what's called a demographic dividend. What that means is there's a significant population that is now coming into the workforce. They're working. They want better products. They want a better lifestyle. And as long as these countries are able to deliver, you're going to see a lot of growth going into the future. So what we're looking for are companies that are not only taking advantage of these demographic dividend countries, but at the same time they are domiciled in countries where there's a very, very good regulatory structure in place. So the large multinationals based in US, based in Europe, that are taking advantage of the global growth are the ones where we want to be.
All right, excellent, thank you. And within the emerging market, and I've noticed that you've mentioned South Korea and Brazil, are there any particular brands or companies where you see real potential?
Sure. I mean, there's been a couple of cases in the past, and there's always going to be new ones coming up in the future. But really, what we're looking for is, for example, if you look at Monster as a beverage company, we spotted that very, very early on as an industry of health consciousness. But really looking at it, they had all natural drinks, they had energy drinks, those type of things, and over time they've become a global brand. Before they were only in the US. And so really what we're looking at is those type of companies that maybe start off in one particular country, but then really grow across the world. One other people might be more familiar with would be something like a Samsung Electronics, right? Before, they used to be only in televisions, before that into only DVDs, really got into the mobile phone market, it went on to the smartphones, and now they truly are a global brand, and they are going to be benefiting for this shift from a PC-based world to a tablet and PC and smartphone-based world.
Are there any particular markets within the emerging market where you see pockets of opportunity?
Absolutely. I mean, I think if you look at majority of the emerging market countries, especially the larger ones, the reason why they're doing so well is because they have the larger populations and they are self-contained. Meaning, for example, if you take certain countries like Turkey or Indonesia or Philippines, they have about 70% of their GDP coming from internal demand. So it's only 30% from outside. So if you're looking at globally and saying, well, what's happening in the world, what's happening to imports and exports, that's really less dependent on these countries. So really what we look for are companies that can benefit from the local demand of the population. And as long as you have the local demand minus any blow-ups that the government might make or the political entities might make, you're really looking at some good growth.
What is your assessment of the market right now, especially, I guess, in the context of the S&P and other global markets?
So, I mean, I think that there's a couple of things that are going on. A lot of companies, for example, in the U.S., are sitting on billions and billions of dollars in cash. That's a very healthy and good sign. In Europe, beaten down companies, but they're good, very, very attractive values. A lot of them are export-driven, so as the euro goes down in value, they're actually becoming more profitable. Companies that come to mind would be things like BMW and those companies. Right now, the market is beginning to understand that, and the S&P and the Dow are beginning to hit post-GFC highs. That we see, I think the market over the past maybe 4 or 5 months has gotten a little bit ahead of itself. I think there's due to be a small short-term correction, but I think, again, looking 1 year out or maybe a little bit further out, things are looking really good. If you want to talk about a short-term call, let me give one to you. So there is an old adage in the market that says, as the first week of January goes, so does January, and as January goes, so does the rest of the year. And so far, we're off to a great start. The S&P is probably up about close to 6% this year. So we, looking at it as like global fund managers with a very heavy weighting of the indexes being in the U.S., we're looking for a very good year this year.
Well, thank you, Monem, and thank you for your time this afternoon, and best of luck for the year.
Thank you very much.